Back from Japan, we had a great 2.5 weeks with my wife, and essentially let's dive back into real estate investment trusts after the 2.5 weeks being away. Now, in my latest write-up in GCP Global website, which details the first half performance of real estate investment trusts, where do we stand? Secondly, the correction that we are seeing in real estate investment trusts, you'll be asking, is it near to an end? Well, delve and dive into our article at GCP Global website, which is available, which contains our last 34 years of investment research for free. And let's dive into one of the first important thing. Now, the first chart that we have, and it ended last week essentially with one important thing. Now, 4 central bankers from the ECB, right down to Federal Reserve Chairman Powell, Jerome Powell, gathered in Sintra, Portugal. And guess what? Many of the indications that I've given and the conclusions that they actually have made after the meeting were actually more confusing than anything for real estate investment trust shareholders who are looking for indications of interest rates peaking so that you can determine when to go on the big into real estate investment trust. Did we get what we're looking for? The answer is no. I've actually detailed in some of the contrary and some of the key confusion, some of the frightening things that they say in my article. So do look at it, which I will cover in next week's video. In this week's video, I'm going to concentrate on the top performing REITs for the first half of this year and the worst 10 performing REITs for the first half of this year, since half year has just gone. Yes, that's right, ladies and gentlemen, half year has just gone. Have you actually enjoyed your life? Have you actually determined that the dividends that you've been receiving from your dividends from your real estate investment trust that is paying you well, is paying for a good life for you? If not, then you have to reassess your real estate investment trust portfolio, and that's what we do. Ladies and gentlemen, the first page is a indication of basically where we stand. You can see that in terms of magnitude, the losses that we have incurred so far from the peak in 5th of April last year, when the Fed first instituted the first rate increase, right up to 30th of June, that's actually the end Friday last week, the FTSE REIT index was down 160 points, or essentially 18.4%. Now, this is by far, the second worst correction in terms of magnitude. The worst was actually 22%, as you can see from the chart. But in terms of actually the length, right now we are suffering the longest 15 months correction in real estate investment trusts without any recovery whatsoever. Does it mean that essentially it's close to an end for real estate investment trusts' current correction as we see it this week? Well, we're going to talk this in greater detail in our 9 September class. Do join us, so that you can actually gain into a very good insight into real estate investment trust, the buying points, the selling points, and what actually constitute in between to actually make good profits. Ladies and gentlemen, shows you the top 10 performing REITs for first half of this year. Not surprisingly, Capital DC REIT is the REIT that is the top performing for the first half of this year, up 22% despite a very lackadaisical FTSE REIT index market. You can see that the others that follow are Fraser Commercial and Lock and Parkway Life, right down to Paragon REIT, right down to Fraser Hospitality Trust, Fraser Centrepoint Trust. Now, for those who have been following us in our channel as well as attending our classes, you notice that many of these REITs were highlighted in our various investment classes. Perhaps some of the best way to actually know how to actually pinpoint and pick winners in real estate investment trusts is to look at how we had been able to do so in our stock picking skills. Take for example the very first one, and this is actually enumerated in the chart. Top performing REIT is Capital DC. You notice that we actually highlighted in our various classes for Capital DC, because throughout 2021, after the pandemic of 2020 and right up to 2022, you see that essentially the REIT has continued to fall. It went below 250, it went below 220, went below $2. At the time, all the analysts in the market were calling a buy. We told our GCP global investors, including our various family offices, very high net worth individuals, and rather very people who are actually very conservative in their investing, that you shouldn't be touching it yet. But when it went below 180 after our lunch, with the CEO of Capital DC REIT then, Ms. Antia Lee, we told in our various classes since the second half of last year that Capital DC is worth buying below 180. Look at the chart, ladies and gentlemen. It went below 180 after a free fall from $3. Now, we have to establish that the free fall from $3 right down to below 180, that's a 40% erosion in value, was not because of weakening fundamentals or change of fundamentals on Capital DC. We established in our classes as well as our weekly REIT videos that essentially it was more because of stretch valuations. Remember, Capital DC was the first REIT that went below 3% dividend yield. Never in the 21-year history of Singapore as-REIT market has REITs dividend yield fell below 3%, and its premium to NAV was almost double. This is by far the highest in the market, and that's why above 3 previously we have already told our investors to sell, and we bought back at below 180. Right now it's 216, so other than the fact that we went in to buy it to 180 below, because of the fact that essentially it's stretch valuations becoming unstretched, dividend yield, which went below 3% when we went to above $3, has come down close to 5%. We went below 180. And of course, we also look at the various AEIs and the various acquisitions that they made for Guangdong Data Center 1, 2, and 3. We established for our investors that essentially all these acquisitions are going to add on accretively, to its DPU, come to 0 to 2 onwards. And you can see, ladies and gentlemen, not only the DPU increase in the first half year results, we're going to see the momentum going forward is going to be there. And that's how we pick winners like this. If you want to find more winners and find which are the other key lynching points, before the share price rises, to join us for a class on 9 September 2023. And mind you can still get the early bird special to sign up before 16th of July. Another example to exemplify how we pick winners, let's look at Parkway Life, which is the best performing REIT in the first half of this year. Now, for those of you who have been attending our classes, yes, we've been conducting real estate investment classes for the last 34 years. Just 2 years ago, we told you that when Parkway went below $5, sell it out, sell it out, sell it out. Why? Because once again, like Capital DC, it was on stretch valuations. Parkway was on a price premium to NAV of double. Never again have REITs basically established, and that was only after Parkway have just established that there's a possibility that they will acquire Mount E Novena. We have established for our investors that it will be a good acquisition, but the fact is that you're not going to get the deal from the parent, that is actually IHH at a cheap price, because IHH is an established listed company. So Parkway Life, if they're going to swallow IHH, boy, their acquisition is going to be so expensive. It's going to be funded by not only external borrowings, basically a preferential rights issue. Definitely, it's going to be a private placement, which will be done at a good discount so that you can encourage take up. So at above $5, we told you sell. But when it went below 370 just recently in our February 25th class this year, we told our investors that, look, at 370, the fall of $1.30 have discounted many of the negatives, while the negatives still remain in Parkway Life. Let's not admit the fact that it's still quite a well-run REIT. It's one of the rare REITs, after all, there's only 38 REITs in Singapore Lab. After the delistings, after the various private mergers and acquisitions. And you can see, ladies and gentlemen, that essentially, some of the perennial favorites will always have topsy-turvy up and down, giving you a very good trading range. So we reckon that below 370, Parkway Life can give us substantial meat, to actually maybe make a 10-20% return in the short term. And of course, if we are looking for a long term, then we have to establish whether it continues to have the kind of stock in the portfolio, the kind of quality that will continue to want you to have in the REIT as your portfolio. And of course, this is something we establish not only in my book, Making Your Millions in Real Estate Investment Trust, but also in our regular classes. So do join us on the 9th of September if you want to know more about Parkway Life in terms of holding it for the short term and holding it in terms of long term. Remember, profits that you have made right now that we sit on are just temporary. If you don't take it, it may evaporate. But if you sell too soon, it may actually, then you are denying yourself of greater profits in the future. So where do we draw the line? This is what we talk about in our real estate investment class, the next of which is the next chart, ladies and gentlemen, shows you the worst performing 10 REITs in the first half of this year. And for those of you who have been following us closely, you notice that we have actually been forewarning you and telling you how bad the US office REITs are. So the likes of Prime REIT, which top the worst performing REIT, Manulife REIT, and Keppel Oat Pacific made up the top 6 worst performing REITs. You see, so not surprisingly on that, we also did warn you on Kilipo Malls, Elite Commercial REIT, ECWO REIT, which we reckon that there is possibly an ongoing going concern problem, if their problem with the loan and the lenders are not resolved. Right now, it appears to be resolved, but then again, there's no long-term resolution to the term covenant. So if you read all the multitudes of information that the company has dished out, they have not categorically established that the banks will be behind them for the next 5 or 10 years to back up what they have said. They only say it's for the next 1 year. And do you want to put and risk your money in this kind of REITs for the next 1 year, knowing that there's so much uncertainties? Well, but if anything, this week, this top 10 list also highlight for the very first time iREIT. Ladies and gentlemen, take a look at iREIT. Goodness me, it's no longer an iREIT. It is UREIT. Why? Because if you read, ladies and gentlemen, in my article, I've established the fact that they have come in to raise funds. It is clear that the REIT cannot actually do a private placement because demand is actually very weak out there. So they have no other choice other than go to do bank borrowings and a preferential offer which means that existing shareholders have to cough out more money. And more importantly, they are actually issuing at a sharp discount, almost close to 10%. As you know, regulations means that you can only issue new shares, maximum 10% discount. And notice that they are coming in at 40.6 cents. One of our criticism on the on iREIT is that when they acquired the 17 assets portfolio in Europe, they mentioned that their initial yield is 7.9%. Now, when I went in and worked out our numbers, based on total cost, because remember, transaction tax as well as property tax in European properties are very high. So if you take that into account based on total cost basis, then the NPI yield is almost 1.5% lower than the 7.9. So it's nearer 6%, not 7.9% as what the REIT has indicated. So once again, ladies and gentlemen, we have always liked to warn and forewarn you on the realities of investing in real estate investment trust. And in this case, iREIT is a case in point. But more importantly, look at the track record of REITs. A leopard doesn't change its sport. You notice that this is a chart since its listing. It was listed in 2014. Now it took like 6 years for it to go from 65 cents to 85 cents. That's 20 cents. Gain. But since the pandemic, see what happened, ladies and gentlemen. The same chart shows that the stock has crashed from 85 cents to 40 cents. And we are nearing 40 cents, the low that we saw during the pandemic of March 2020. What do you make of this? All the other REITs in the markets, or practically all the other REITs, like CapitaLand, Mapletree, and Fraser Centre have recovered and are at least 50% above the pandemic crisis low. Whereas I-REIT, or what you call U-REIT, is coming close to its pandemic 2020 low. Well, as always, the share price speaks for itself. So once again, ladies and gentlemen, if you want to be forewarned on other REITs like I-REITs before they become U-REITs, that is essentially before they do things that are probably disadvantageous shareholders, we warned and forewarned this in our class. To join us, catch the early bird special, go to the GCP Global website. Sign up, for our 9 September class, and because that's where we establish which are the better REITs to hold in your portfolio, which are the ones that you should be forewarned about before they do acquisitions that are probably not as advantageous to shareholders like you and me, and therefore, who suffers? The share price suffers. When the share price suffers, who suffers? Hey, not the manager, not the sponsor, but you, the poor shareholder. So till next week, adios, amigo.